Morning, everyone. Welcome to the session. I hope you're feeling well this morning. Okay, I hope you had a good weekend. All right, so welcome to my class today on the YouTube channel of Unacademy. And before that, I would like to welcome you to Unacademy, India's largest online learning platform that gives to you a world of courses, resources, content, live and recorded sessions to help you in your preparation for the CA Foundation and Intermediate examinations by providing top educators, quality content, and overall a great learning experience. So come, let's crack CA exams with Unacademy, India's largest online learning platform. Welcome to my session once again. Before we proceed, one second. A brief introduction about the Educator today. Hello, I'm Prathik Gupta. I am a Bachelor of Commerce from Christ College, Bangalore University. I am an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of Cost Accountants of India, and an associate member of the Institute of Company Secretaries of India, and also a law graduate from Karnataka State Law University. I'm currently a practicing chartered accountant and also a visiting faculty for CA subjects and an educator for CA students, both offline and online. Prior to starting on my own, I worked with S.R. Bartley Boy and Associates, that is the Indian member firm of Ernst & Young Global in the Audit and Assurance department. Then I went on to work with Ernst & Young India, E&Y India in the Mergers and Acquisitions department, and then finally I went on to work with the Manipal Group in Bangalore as the corporate controller of their Indian entity as well as their German subsidiary located in Frankfurt, Germany. It was only after I got back from Frankfurt, Germany that I decided to start something on my own, and that also gave me an opportunity to become an educator, which in turn has given me this opportunity today to be able to take this session for you young, fine and bright CA aspirants. Thank you so much for giving me this opportunity, and anytime during the session, in case you have any questions, queries, observations or discussions to be made, please do not hesitate to drop in a line and I will take up the matter for problem solving or for discussion purposes as the case may be as soon as possible. I hope you find this session useful. I would also like to draw your attention to my name and the spelling of my name. My name is Prathik Gupta. It's Prathik Gupta. It's Prathik with an H, Prathik. Now, why I'm stressing on the spelling of my name is because a lot of people miss the H in my name, because of which they misspell my name and they're unable to find my numerous number of hours on the YouTube channel of Unacademy, as well as my numerous number of special classes on the Unacademy Learning app. So, you can look me up with my name, that is Prathik Gupta, Prathik Gupta, and you will find the numerous number of sessions that I've taken on the YouTube channel of Unacademy as well as the Unacademy Learning app in the form of special classes as well as YouTube classes. Alright, now I told you that Unacademy caters to you in your preparation for the CA Foundation and Intermediate examinations. So it does so through three platforms: YouTube, Special and Plus. Now YouTube and Special classes are absolutely free of cost, but they provide a tremendous amount of value and resources to help you in your preparation for the CA Foundation and Intermediate examinations. YouTube is what you're watching right now, where you just need to go onto the YouTube channel, type in Prathik Gupta, and you'll see all my sessions that I've taken on the YouTube channel of Unacademy, which will help you in your preparation for the CA Foundation and Intermediate examination. Similarly, special classes are also absolutely free of cost, but they provide tremendous amount of resources to help you in your preparation for the CA Foundation and Intermediate examinations. Special classes are available on an app known as the Unacademy Learning app, more about which I will tell you in the following slides. Coming to the Plus platform of Unacademy, the Plus platform of Unacademy is the premium platform of Unacademy, that is a payment-based subscription model and which provides various subscription packages for the various examinations. More about those subscription packages in the following slide. But in this slide, I will quickly tell you as to why I recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible. The first reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the daily live classes it provides, where you get to chat with your educator, engage in discussions, ask your doubts and answer polls, all this while the class is going on. The second reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the live tests and quizzes it conducts on a regular and periodic basis, which help to evaluate your preparation and also get a detailed analysis of your performance. The third reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the structured courses it provides, where all our courses are structured in line with your exam syllabus to help you best prepare for it. And lastly and most importantly, the reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the unlimited access it provides, where the one subscription to the Plus platform of Unacademy gets you access to all our live and recorded courses to watch from the comfort of any of your devices. So, keeping these advantages in mind among many others, I strongly recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. Moving on, now in the previous slide you heard me say live and recorded courses. So those live and recorded courses are live and recorded plus courses and live and recorded special classes. So if you're wondering where they are available on an app known as the Unacademy Learning app. So for all of you who have downloaded the Unacademy Learning app, registered on it and are using it, I thank you very much and I request your support in the future as well. For those of you who have not yet downloaded the Unacademy Learning app or are not yet on the Unacademy Learning app, I request you to go to the Play Store on your mobile phones, download the Unacademy Learning app, install it on your phones, put in your mobile number where you will get an OTP, and using that OTP you can register on the Unacademy Learning app. It is as simple as this with no lengthy or complicated procedures. So the next question might be, okay, I have downloaded, installed and registered on the Unacademy Learning app. So what's next? So let me tell you that the Unacademy Learning app gives you access to all the live and recorded special classes that Unacademy has to offer to you to help you in your preparation for the CA Foundation and Intermediate examinations. And not only this, the Unacademy Learning app also gives you access to all the live and recorded plus courses that Unacademy has to offer to you in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. So keeping these points in mind, I request you to download, install and register on the Unacademy Learning app as soon as possible so that you can make use of the world of resources that Unacademy has to offer to you to help you in your preparation for the CA Foundation and Intermediate examinations. Alright? Moving on. Now this is an important slide. Like I told you, the Plus platform of Unacademy is the premium platform of Unacademy, that is a payment-based subscription model and which provides various subscription packages for the various examinations. Accordingly, the CA Foundation and the Intermediate subscription package provided by the Plus platform of Unacademy are as follows. The packages provided are for 1 month, 3 months, 6 months, 12 months and 24 months. The 1 month package will cost you rupees 3,500. The 3 month package will cost you rupees 8,750. The 6 months package will cost you rupees 14,000. The 12 months package will cost you rupees 17,500 and the 24 months package will cost you rupees 21,000. Now please remember, all these are the listed price of the packages. So before you make the payment for the package of your choice, please do not forget to use the code Prathik to get an instant discount of 10% on the above listed price. I repeat, please do not forget to use the code Prathik, P-R-A-T-H-I-K, that's me, to get an instant discount of 10% on the above listed price. So the after discount price of the various packages are as follows. The 1 month package will cost you rupees 3,150. The 3 month package will cost you rupees 7,875. The 6 months package will cost you rupees 12,600. The 12 months package will cost you rupees 15,750 and the 24 months package will cost you rupees 18,900. So you see, immediately you get a savings or discount of 10% when you use my code Prathik. Now, an important announcement. Please remember, this discount of 10% is being reduced to 5% from 1st March 2021. I repeat, this discount of 10% is being reduced to discount of 5% from 1st March 2021. So that means this discount of 10% is applicable only till the end of the day, till Feb 28, 2021. So for all of you that who have been thinking about joining the Plus course or have decided but not yet joined the Plus course, this is the time for you to enroll for the Plus course and avail a benefit of the 10% discount that Unacademy is offering to you. But don't forget to use the code Prathik to avail this discount. Alright, as from 1st March, it is becoming 5%. Now, I personally recommend you to start off with the 12 months and 24 months packages for 2 reasons. Firstly, it is cost effective. If you compare the 1 month package cost with the per month cost of the 6 months of the 12 months and 24 months package, you will see that you're getting great cost savings almost immediately. And secondly, and most importantly, since the CA Foundation and Intermediate courses are provided to you in one package, that is 12 months or 24 months, a 12 months or 24 months package will be highly beneficial to you because it covers the duration of both your courses, that is the CA Foundation and the Intermediate, which normally take a minimum of about 12 months for you to prepare and clear. So if you're getting a package that is 12 months or 24 months that covers the duration of your CA Foundation and the Intermediate course at a very cost-effective price, I think that is a very good deal. But having said this, you're free to choose the package of your choice. But before you make the payment, please do not forget to use the code Prathik to get an instant discount of 10%. Again, this discount is being reduced to 5% from 1st March 2021. So please grab your Plus subscriptions before March 1st, 2021 to avail a discount of 10%. Okay, you can also make use of the no-cost EMI options available for the 6 months, 12 months and 24 months packages. just in case you do not wish to make the entire payment at one shot. The payment options available to you are internet banking, debit card, credit card, and also all the coins that you've accumulated by watching the special classes can be redeemed while making the payment for the Plus course. So keeping these points in mind, these packages in mind, these incentives and these offers in mind, I strongly recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible in order to accelerate and enhance your preparation for the CA Foundation and intermediate examinations. Okay, let's move on. Now, like I told you, the Unacademy Learning app gives you access to all the live and recorded special classes that Unacademy has to offer to you. Here are the snapshots of few of the many special classes that I have conducted on the Unacademy Learning app. There are special classes on revision test papers, the Sale of Goods Act, the Indian Contracts Act, the Companies Act, Fundamentals of Accounting, Retirement of Partner, Death of Partner, Admission of Partner, Valuation of Inventories, Revision on Final Accounts of Non-Manufacturing Entities, Revision on Sale of Goods on Approval or Return Basis, numerous amount of MCQ quizzes and other things that have been taken at the Unacademy Learning app in the form of special classes, both for the foundation and the intermediate level. So all you need to do is log into the Unacademy Learning app, go to my profile, Prathik Gupta, and you'll see the hundreds of hours of special classes that have been taken there exclusively for your benefit. Alright? Yes, let's move on. Also, here are the links to few of the many special classes that I have conducted on the Unacademy Learning app. You can either click on these links or copy and paste these links on your browser to take you directly to my special class on the Unacademy Learning app. There are special classes on the Indian Contracts Act, the Sale of Goods Act, the Indian Partnership Act, the Limited Liability Partnership Act, the Companies Act, Basics of Communication, Accounting Concepts, Revision Test Papers, and many more. So like I told you earlier, please log into the Unacademy Learning app, go to my profile, and you can make use of the hundreds of hours of special classes that I've taken there exclusively for the benefit of the CA Foundation and intermediate students. And after going through them, in case you have any questions or queries, you can always get back to me. On my profile on the Unacademy Learning app, there is a follow button. Please click that follow button and then you'll be able to message me from there, and I will receive your messages and I will respond to you. Alright? Let's move on. So now today we're going to talk about the Indian Contracts Act, the Contract of Indemnity and Guarantee, Part 2. Part 1 was done yesterday. So the people who missed it can go back to my session where we had a good discussion for about 2 hours and 15 minutes on the important aspects of Contract of Indemnity and Contract of Guarantee. We will continue with that. But before that, we will have a quick recap of what we have done yesterday, and you can recollect to a large extent whatever you missed. Okay, I will not go into detail what we did yesterday, but I will just give you about 20-30 seconds and I'll ask you to read it, and then we will proceed. All right. So this is what we read, the introduction. So the Contract of Indemnity or Guarantee are contained under the Indian Contracts Act 1872. You would have studied the Indian Contracts Act 1872 in your foundation. Okay, but now this is in your intermediate course. This is a little more specific where we are dealing only about Contract of Indemnity and Guarantee. Alright, please take about 30 seconds, go through this introduction. Now till wherever I have done yesterday, I will give you 30 seconds and ask you to read it, and we will continue from where we stopped yesterday. Okay, if in case this also you have any questions, you can always ask me. Just give me a second, I just get some water, just give me a second. Yes, sorry. Okay, move on. Now this is about a contract of indemnity. A contract of indemnity is simply a contract where one person undertakes to indemnify or reimburse the loss incurred to another person due to the acts of the first person or any other person. That is a contract of indemnity. Okay, take about 20 seconds, go through this. Okay, let me know once you're done, please. Okay, then look at these 3 examples quickly. Take about 10-15 seconds. Go through this, please. We have done this yesterday, so I'm just trying to recap it for you quickly. I'm not explaining these. on, are we done with this? Okay. Now the modes of contract of indemnity, it can be express or implied, and this slide tells you that all the other essential elements of a valid contract should also be contained in a contract of indemnity. What are the other essentials? Offer and acceptance, intention to create legal obligation, consideration, competency to contract, free consent, lawful object. The agreement must not be expressly declared to be void. An agreement in restraint of trade, marriage, etc. The terms of the agreement must not be vague or uncertain. So all the other essential elements of a contract should also be present in that contract of indemnity. Okay, please take about 30 seconds, go through this, and then we proceed. Okay, please remember all these have been done yesterday in detail, so I'm not spending too much time on this. Come on. Okay, then rights of indemnity holder when sued. Okay, the promisee. So whenever the indemnity holder claims from the indemnifier, he can claim all this 1, 2, and 3, all the damages that he may be compelled, all the costs for the suit, and any sums which either the court may order him to pay. All this can be claimed from the indemnifier. Okay. Come on, take 30 seconds, go through this. Come on. Take about 10 seconds more. Okay, then when does the liability of the indemnifier commence? As per the slide, the liability of the indemnifier commences the minute the indemnity holder is liable to pay something. So whatever amount the indemnity holder is liable to pay, the indemnifier also has to pay that same amount, and his liability starts right then from there. Okay. Come on, take about 10-15 seconds. Come on. Any questions, please ask. All right, then the contract of guarantee. So far we discussed about contract of indemnity. Now we go to a contract of guarantee. A contract of guarantee is a contract to perform the promise made or discharge the liability of a third person. So if any other third person has taken a loan or made a promise to someone, and another person guarantees or acts as a surety to repay that amount to that third person, it is known as a contract of guarantee. There are three parties involved in a contract of guarantee. That is a surety, that is the person who gives the guarantee, the principal debtor in respect of whom the guarantee is given, and the creditor, that is to whom the guarantee is given. Okay, please take 10 seconds, go through this. Any questions, please ask me. Carefully go through this. Come on, go through these examples of a contract of guarantee, which will help you understand it better. Take about 20 seconds, go through this carefully. We are just recapping what we did yesterday. Come on. Okay. Now again, take about 10 seconds, go through this. Come on. Okay, are we done? Alright, now essential features of a guarantee. Now there are about 6 or 7 essential features of a guarantee. Carefully go through this, take about 30 seconds. Go through the slide, it's important for you to know. We discussed this in detail yesterday, but I'm just trying to recap it for you today. Okay, let me know once you're done, then we will go on to the next one. Okay, quickly go through this, the examples and the third characteristic of a contract of guarantee. We have done this yesterday, but I'm trying to recap it for you, give you about 30 seconds to go through this, and then we will continue from where we stopped yesterday. Come on, take about 20-25 seconds to read this slide. Any questions, please ask me. Come on. Okay, then we have the fourth, fifth, and sixth, no misrepresentation or concealment. That means the contract of guarantee should not be created by any misrepresentation or concealment, otherwise it will be void. The writing of a contract of guarantee is not necessary. And also there might be certain contracts of guarantees where one surety may ask for the joining of other co-sureties for it to be effective. Okay? Right, take about 30 seconds, go through this. Come on. Come on, take about 10 seconds, go through this, and then we proceed. We have done this yesterday in detail, so I'm just giving you time to recap. Come on, okay, then types of guarantee. We also spoke about what are types of guarantees. The types of guarantees are specific guarantee and continuing guarantee. Specific guarantee is for a specific transaction and it ends when the transaction is over. Or continuing guarantee is when it continues over a series of transactions or for a particular time. Okay, and it continues until that time is lapsed or those series of transactions are lapsed. Okay, please take a minute, go through this. Come on. Go through this, please. Okay, then this was an important question, what we saw yesterday, important topic, the difference between a contract of indemnity and a contract of guarantee. where there were 5 parameters, the number of parties, nature of liability, time to act, and purpose, and these were the five differences. It's an important question, okay? Please take about a minute, go through this. Any questions, please ask me. Come on. Please take about 30 seconds, go through this. It's an important topic, an important question from the exam point of view as well. It was discussed in detail yesterday, but I'm just trying to recap it for you today. Come on. Come on, take about 30 seconds more. Carefully go through this. Are we done? Okay. Then the nature and extent of surety's liability. That is, to what extent is a surety liable for the debts of the principal debtor. Go through this. Take 30 seconds. Go through this, please. Come on. Take about 30 seconds, go through this. This was done yesterday, so I'm just trying to recap it to you. We will very soon start continue with where we stopped yesterday. Okay, then we also discussed about continuing guarantee. Like I told you, a continuing guarantee is a guarantee which goes on for a series of transactions or over a period of time, and this guarantee ends when those series of transactions end or that time lapses. So for example, if there is a landlord and he's got a lot of properties, okay, and he is looking for a person who can collect all those rents from the properties on the 1st of every month, and on the 5th of the month give it to him. So let's say if I go and bring another person who I know and I say, okay, this is the guy who will do the job for you. So if that landlord is not too sure, he'll be like, give me a guarantee. So in case I give a guarantee that, okay, I guarantee that this fellow is an honest fellow, and as long as he's working, if there's anything that goes wrong, I will pay the money. So that is a continuing guarantee that I've given for that employee, and as long as that person remains in employment of that landlord, then the guarantee continues. It could be 6 months, 1 year, 2 years, 3 years, or whatever. And in case the employee conducts any default, then I will have to pay the money. That is called as a continuing guarantee. Whereas a specific guarantee is, let's say B is taking a loan from C for 5 lakhs. And C says, no, give me a guarantee. So B comes to me and says, sir, please give a guarantee. No. So I give a guarantee only for that 5 lakhs. So if in case B defaults in that 5 lakhs, then I pay that 5 lakhs and I close it. Or when B refunds or returns the entire money to C with interest, my liability as a guarantee gets done. Okay. So that is a specific and continuing guarantee. Take 10 seconds, go through this, please. Okay, take another example, take 10 seconds, and then we proceed. Okay, take 5 more seconds and then we proceed. Okay, so now let's start off with the liability of two persons, primarily liable, not affected by arrangement between them, that one shall be surety on others default. Okay, so now we look at a situation where what is the liability of two persons who are primarily liable but are not affected by the arrangement between them, that one shall be surety on the other's default. Okay, when two persons contract with a third person to undertake a certain liability and also contract with each other that one of them shall be liable only in the default of the other. The third person not being a party to the contract, the liability of each of those two persons to the third person under the first contract is not affected by the existence of the second contract, although such third person may be aware of this existence. So this simply means, let's say A and B jointly take a loan from C. Okay, now what is the contract? The contract is between A, B and C when they take a loan of 5 lakhs from C. Now among A and B, if they decide that don't worry yaar, if B defaults, I will pay the loan. If A says, or if B says, A, no problem, if you default, I will pay the loan. So among them, there is a guarantor or surety agreement. So what this means is this second agreement between the two lenders or two borrowers does not affect the main contract between the main person C and AB. Okay, if God forbid if they default in making the payment to C, C can ask the money from anyone. C can ask the money from AB, both of them, or individually A or B. Okay, so then it's among them to give the money to C. Alright, so when two persons contract with a third person to undertake a certain liability and also contract with each other that one of them shall be liable only on the default of the other, the third person not being a party to the contract is liable. The liability of each of such two persons to the third person under the first contract is not affected by the existence of the second contract, although such third person may have been aware of its existence. Let's take an example. AB make a joint and several promissory note to C. A makes it in fact as surety for B, and C knows this at the time when the note is made. The fact that A, to the knowledge of C, made the note as surety for B is no answer to a suit by C against A upon the note. So what this simply means, let's take A, let's take B. So A and B jointly take a loan from C of 5 lakhs. Okay, so now if they've taken a joint loan, they need to repay it to C as well. Now who repays it, whether it's A or B, C doesn't care. C wants his money back. Okay, so in that case, now if A and B have made an agreement, if A and B have made an agreement among themselves about who's the surety and who's this thing, then that does not concern with C. Tomorrow, if the default happens and let's say A has acted as a surety for B, okay, and C, with the default of 5 lakhs plus interest has happened, C can ask money from B and say, you give me the money. You get it from wherever you want, but please give me the money. Okay, so in that case, what this simply means is when there is a contract between two borrowers, that does not affect the lender. Okay, the lender can ask the money from anyone. It is up to the borrowers to give the money. Please take a minute, go through this. Any questions, please ask. Come on. Please take 30 seconds, go through this. Any questions, please ask me. Go through the example as well, that will help you understand it. Come on, let me know once you're done. Okay, are we done? Alright. Then, next this is an important topic. When is the surety said to be discharged? Okay, what do you mean by this? Now, a surety is said to be discharged when his liability as surety comes to an end. The various modes of discharge of a surety are discussed below. Now, what do you mean by the term discharge? Can anyone tell me? The term discharge simply means when does the liability of the surety come to an end. Now, the liability of the surety, let's say A has taken a loan, has given a loan to B, okay? A loan of 5 lakhs to B, for which C is the surety, okay? Now C is the surety. What does this mean? So A has given a loan to B and C has stood as a guarantor for B, telling A that don't worry, if B does not give you your 5 lakhs plus interest or something, I will pay it to you. Okay, so C, like a Superman, like a He-Man, comes in and he says, I am the guarantor, don't worry, I will pay the money to you. Now there can be two situations. On the due date, either B can repay the entire 5 lakhs along with interest to A. Okay, in that case, the minute B repays the entire 5 lakhs along with interest to A, C's liability or C's surety is said to be discharged. Okay, because the amount for which he was standing as surety, that has been repaid by B to A. Okay, now this is the first situation. Now what is the second situation? Now let's take the second situation where B on the due date defaults. Okay, defaults means he does not repay the loan of 5 lakhs to A. Now in this case, what can happen? Now in this case, A can directly go to C and tell him, okay, now your B has defaulted in the payment, please pay me my 5 lakhs. So in this case, because C stood as a guarantor and surety, C will have to make the payment of 5 lakhs plus interest plus any other expenses to A. And once he does that, his liability is discharged. His contract is discharged. Now, what happens once C's liability is discharged? The immediate next thing is, because C was standing as a guarantor for B, C can recover the money from B or file a case on him for recovery of money. Okay, but he will have to pay that money to A. And once he pays that money to A, his liability will be discharged. Alright. A surety is said to be discharged when his liability as surety comes to an end. The various modes of discharge of surety are discussed below. A, by revocation of the contract of guarantee. Now the first method by which the surety is discharged of his liability is by revocation of the contract of guarantee. That is where the guarantor cancels the contract of guarantee. He says, no, I am not standing guarantee for him. Please cancel the contract. So in that case, the surety is discharged. This means, revocation means cancellation. Okay. Then by the conduct of the creditor. So in case the conduct of the creditor is not good, or the creditor cheats, or the creditor obtains the guarantee by fraud or by misrepresentation, then in that case, the contract of guarantee is said to be discharged and said to be cancelled. Okay. So you can say by misrepresentation or fraud. Okay. Then the next way, by invalidation of the contract of guarantee. Then also in a lot of situations, the contract of guarantee can be invalidated. How can it be invalidated? It can become invalidated when there is unauthorized alteration in the terms of contract of guarantee. Then when there is any changes which the guarantor does not know about, or there is any sort of fraud, then in that case it can be changed. So the first one, revocation of a continuing guarantee by notice. So in the following situation, revocation can be done by notice. The continuing guarantee may at any time be revoked by the surety so as to future transaction by notice to the creditors. A specific guarantee can be revoked only if liable to principal debtor has not been accrued. So now please remember, like I told you, there are two types of guarantees. One is your specific guarantee and one is continuing guarantee. So if there is a specific guarantee that is for a particular amount, then in that case the surety cannot give a notice and cancel his guarantee anytime, but he can do it only when the liability has not accrued on him. Okay, that means the principal debtor has not defaulted, then he can do it. Alright, but in case of a continuing guarantee, the surety can cancel the contract anytime by giving notice to the creditor. Please take a minute, go through this. Any questions, please ask me. Any questions, please ask. Come on, let me know. Take a couple of minutes, carefully go through this. Any questions you may have, please ask me. We will be discussing each point in detail. Any questions, please ask me. Let me know once you're done, please. Take about 30 seconds more. Are we done? Let me know once we're done, please. Come on, take another minute, carefully go through this. Any questions, please ask me. Are we done? Okay, now let's look at an example. Example 1, A in consideration of B's discounting at A's request, bills of exchange for C. Guarantees to B for 12 months the due payment of all such bills to the extent of 50,000 rupees. B discounts bill for C to the extent of 20,000 rupees. Afterwards, at the end of 3 months, A revokes the guarantee. This revocation discharges A from all liability to B for any subsequent discount. But A is liable to B for 20,000 rupees on default of C. So in this current example, you see that once any particular transaction has happened and a person has provided a guarantee, then he cannot withdraw from that transaction. But from the future transactions, he can withdraw from becoming the guarantor. Okay, so A is liable to B for rupees 20,000 on the default of C. Example 2, A guarantees to B to the extent of 1 lakh rupees that C shall pay all the bills that B shall draw upon him. So that means A gives a guarantee on behalf of C to B. B draws upon C. C accepts all the bill. A gives notice of revocation. C dishonors the bill at maturity. A is liable for his guarantee. Now, why do you think A is liable for his guarantee? Because A has given a guarantee that C shall pay all his bills that B shall draw upon him. So B draws a certain amount of bills. C accepts all the bills. So his guarantee is applicable there. A gives notice of revocation. So that means from next onwards, if any bill is raised by B, then he will not be liable. But up till that point, whatever bills have been raised by B, A's guarantee is applicable. So A gives notice of revocation. C dishonors the bill at maturity. A is liable upon his guarantee. Let's take a look at the third example. X gives guarantee to the extent of 50,000 rupees for the loans given from time to time by A to B. Okay, so A is standing as a guarantor for B to A. Okay, X is standing as a guarantor on behalf of B to A. A gave loan of rupees 1 lakh to B. Afterwards, X gives notice of revocation. X is discharged from all liability to A for any loan granted after the revocation of guarantee, but he is liable to A for rupees 1 lakh on default of B. Okay, 10,000, sorry. So until the date of revocation, whatever guarantee the guarantor has given, he is liable for it. After that, he is not liable. Okay, please take a minute, go through this. Any questions, please ask me. Any questions, please ask. Come on. Come on, please take a couple of minutes. Any questions, please ask me. Please take a couple of minutes, carefully go through this. Any questions, please ask. Come on. Any questions, please ask. Let me know once you're done, please. Okay, now let's look at the second way in which the guarantee is revoked. The second way is revocation of continuing guarantee by surety's debt. So in case there is a continuing guarantee, in the absence of any contract to the contrary, the debt of surety operates as a revocation of a continuing guarantee as to the future transactions taking place after the death of the surety. So let's say there is a continuing guarantee and the surety dies. Then the surety is discharged for all the liabilities after his death in a continuing guarantee as to the future transactions taking place after the death of surety. However, the surety's estate remains liable for the past transactions which have already taken place before the death of the surety. So what do you mean by this? The surety's estate means his personal assets. Please remember, his legal heirs or his representatives are not responsible, but they are responsible only to the extent of money that they have received from the surety after his death. That those are his personal estates. So his personal estates are liable for past transactions. Where is it? Which have already taken place before the death of the surety. So after the death of the surety, a continuing guarantee is discharged. There is no guarantee on that. But before that, before his death, if there was any guarantee he gave or any liability that accrued to him, his personal estates are liable for the same. By novation, novation means again substitution of a contract. The surety under an original contract is discharged if a fresh contract is entered into, either between the same parties or between the other parties, the consideration being the mutual discharge of the old contract. So if one contract between the surety has been replaced by a second contract, then the first contract becomes invalid due to novation. We saw it also in discharge of contracts under the Indian Contracts Act 1872. So when any old contract is replaced or substituted by a new contract, the old contract becomes discharged. So similarly, in a contract of guarantee as well, when there is an old contract between the surety and the other people, and then a new contract comes into place substituting the old one, then the old one is invalid and discharged, and so the liability of the surety under the old contract also is discharged. Okay, then by conduct of the creditor, by variance in terms of the contract, where there is any variance in terms of the contract between the principal, debtor and creditor without the surety's consent, it would discharge the surety in respect of all transactions taking place subsequent to such variance. So now, please remember the principal, the guarantor is an integral part of the contract between the principal, debtor and creditor. And in case the creditor and the debtor change the terms of the contract without the knowledge or the consent of the guarantor, then in that case it would be an unauthorized alteration, and then it would discharge the surety in respect of all transactions taking place subsequent to such variance. Okay, please take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask. Come on. Any questions you may have, please ask me. Take 2 minutes. Go through this. Let me know once you're done, please. Come on, take another minute, please. Any questions, please ask. Come on. Come on. Take another minute. Any questions, please ask me. Let me know once you're done, please. Okay, then let's look at an example again here. Example 1. A becomes surety to C for B's conduct as the manager in C's bank. Okay, so A becomes surety to C for B's conduct. So A stands as a surety for B, who is being taken as a manager in C's bank. Okay, afterwards B and C contract without A's consent that B's salary shall be raised and he shall become liable for 1/4 of the losses on overdrafts B allows the customer to overdraw and the bank loses a sum of money. A is discharged from his surety by the variance made without his consent. So the minute B and C change the contract, terms of the contract without the knowledge or consent of A, then A gets discharged from that liability and is not liable to make good the losses. Okay, so in that case, B, who has signed with C that he shall be liable for 1/4 of the losses, he will be personally liable for it, and A's guarantee will not hold good. Let's take the second example. A guarantees C against the misconduct of B in an office to which B is appointed by C, and of which the duties are defined by an act of the legislature. By a subsequent act, the nature of the office is materially altered. Afterwards, B misconducts himself. A is discharged by the change from the future liability under this contract. Under this guarantee, though the misconduct of B is in respect of a duty not affected by the later act. So, you notice here that whenever there is any unauthorized alteration in the terms of contract between the principal debtor and the creditor, without the knowledge of the guarantor is absolutely discharged from his liability. Let's take the third example. C agrees to appoint B as his clerk to sell goods at a yearly salary upon A's becoming surety to C, for B is duly accounting for monies received by him as such clerk. Afterwards, without A's knowledge or consent, C and B agree that B should be paid by a commission on the goods sold by him and not a fixed salary. A is not liable for any subsequent misconduct of B. Again, why? Because the contract between B and C was altered without the knowledge and consent of A. So A will not be liable for any subsequent misconduct of B. Alright, please take a minute, go through this. Any questions? Please ask me. Any questions? Please ask me. Come on. Please take a couple of minutes, go through this. Any questions? Please ask me. Let me know once you're done, please. Are we done? Come on, let me know once you're done, please. Take another minute. Come on. Okay, any questions? Please ask me. Take a minute, go through this. Any questions whatsoever, please ask me. Anyone? Any questions? Come on, any questions do you have? No? Let's move on. Okay, let's look at the other example, example number 4. A gives to C a continuing guarantee to the extent of 3 lakhs for any oil supplied by C to B. So basically A is giving a guarantee on behalf of B. Okay, A gives to C a continuing guarantee to the extent of rupees 3 lakhs for any oil supplied by C to B on credit. Afterwards, B becomes embarrassed and without the knowledge of A, B and C enter a contract that C shall continue to supply B with oil for ready money and that the payment shall be applied to the then existing debts between B and C. A is not liable on this guarantee for any goods supplied after this new agreement. So even here we see the original agreement was that A gave a guarantee. A gave a guarantee to on behalf of B for a contract between B and C. Okay. Subsequently, B and C altered the contract without the knowledge of A. So from the time the contract is altered without the knowledge of A will not be liable for any contract or any transactions between B and C, and that will be at their respective risks. Example number 5. C contracts to lend B rupees 5 lakhs on the 1st of March. A guarantees repayment. Okay, so what I'm saying, C contracts to lend B on 5 lakhs on 1st March. A guarantees the repayment. So A guarantees that in case B does not repay the money to C, he will repay it. C pays the rupees 5 lakhs to B on 1st January. A is discharged from his liability as the contract has been varied in as much as C might sue B for the money before March. So what was the original contract? The original contract was that C will give money of 5 lakhs to B on 1st March. Okay, and for this C stood as a guarantor, saying that okay, if B does not repay the money to C, I will repay the money. Don't worry about it. Okay, but instead of 1st March, C gave the money to B on 1st Jan. Now please remember that is a material alteration to the contract because the money was supposed to be given on 1st March, but instead of 1st March, the money is given on 1st Jan. So in this case, A is discharged from his liability because there is an alteration in the contract, and instead of 1st March, the money is being given on 1st Jan. Okay, then the next method of discharge of surety is by release or discharge by principal debtor. The surety is discharged if the creditor enters into a fresh new contract with the principal debtor by which the principal debtor is released, or if does any act or omission, the legal consequence of which is the discharge of the principal debtor. So in case the principal debtor is released from his liability by the principal creditor, either due to a new agreement or by doing any act or omission. So if the principal debtor is released, then subsequently along with it, simultaneously, the guarantor is also discharged from his liabilities. Please take 2 minutes, go through this. Any questions? Please ask me. Come on. Any questions? Please ask me. Come on. Please take another minute, carefully go through this. Any questions you may have, please ask me. Let me know once you're done. Please take another minute. Carefully go through these three examples. You will understand when is the surety discharged of his liability. Take another minute, please. Carefully go through this. Any questions, please ask me. Come on, everyone. Take about 30 seconds more. Go through this. Are we done? Let me know once you're done, please. Okay, are we done? Come on. Take a minute more. Any questions, please ask me. Okay, then discharge of surety when creditor compounds with or gives time or agrees not to sue principal debtor. So this is another instance where the liability of the surety is discharged. When the contract between the creditor and the principal debtor by which the creditor makes a composition with or promises to give time to or promises not to sue the principal debtor discharges the surety unless the surety assents to such contract. Okay, so that means if there is any contract that our agreement happens between the principal debtor and creditor that the principal creditor will not sue or take action against the principal debtor, and this happens without the consent of the surety, then in that case the liability of the surety is discharged. First one is composition. If the creditor makes a composition with the principal debtor, composition means an understanding, without consulting the surety, the latter is discharged. Composition inevitably involves variation of the original contract and therefore the surety is discharged. Promise to give time, where the time for the payment of the guaranteed debt comes due, the surety has the right to require the principal debtor to pay off the debt. Accordingly, if one of the duties of the creditor towards the surety not to allow the principal debtor for more time for payment. So in case on the due date, the principal creditor allows more time to the principal debtor for repayment of his dues, in that case, the surety is discharged of his liability. Promise not to sue. If the creditor, under an agreement with the principal debtor, promises not to sue him, the surety is discharged. The main reason is that the surety is entitled at any time to require the creditor to call upon the principal debtor to pay off the debt when it is due, and the right is positively violated when the creditor promises not to sue the principal debtor. So it is the first right of the creditor to ask the money from the debtor and then come to the surety. So in case the creditor promises not to sue the principal debtor, then that is a violation of the rights of the surety, and in the minute that happens without the knowledge of the surety, the surety is discharged of his liability. Please take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask me. Come on, please take another 2 minutes, go through this carefully. Any questions, please ask me. Any questions, you may please ask me. Come on. Please take another minute, go through this carefully. Come on, take another minute, go through this. Any questions, please ask. Come on, just take another 10 more seconds and then we proceed. Any questions, please ask me. Okay, let's move on. Now, cases where surety is not discharged. So far, we discussed the cases where the liability of the surety is discharged. Now, let's look at the cases where surety is not discharged. 1. Surety not discharged when agreement made with the third person to give time to principal debtor. When a contract to give time to the principal debtor is made by the creditor with the third person and not with the principal debtor, the surety is not discharged. So, like we saw in the previous cases, whenever the principal debtor and creditor enter into a contract to give more time to the principal debtor to repay the amount without the knowledge of the surety, that time the surety is discharged, right? But in case the principal where the contract to give time to the principal debtor is made by the creditor with a third person, not with the principal debtor, then in that case the liability of the surety is not discharged. Why? Because the creditor is not making a contract with the debtor, he is making a contract with a third person, okay, whether he should give time to principal debtor or not. So the original contract between the principal debtor, the surety, and the creditor remain the same. Okay, example. C, the holder of an overdue bill of exchange drawn by A as surety for B and accepted by B contracts with M to give time to B. A is not discharged. So here he is contracting with M. Okay. C is contracting with M. He is not contracting with A or B. And M is an outsider to the contract. So in this case, A is not discharged. Okay. The second one. The creditor's forbearance to sue does not discharge liability. Creditor's forbearance means refusal to sue the principal debtor does not discharge surety. Mere forbearance on the part of the creditor to sue the principal debtor or to enforce any other remedy against him does not, in the absence of any provision in the guarantee to the contrary, discharge the surety. So just because the principal creditor is refusing or he is delaying to file a case against the principal debtor, that does not remove or cancel the liability of the surety. Let's take an example. Where is the markers? Okay. B owes to C a debt guaranteed by A. So A has guaranteed a debt on behalf of B to C. The debt becomes payable. C does not sue B for a year, and after the debt becomes payable. A is not discharged from his surety. Now here again the Limitation Act comes into the picture. The A has a choice. 3 years or 5 years, whenever he wants to file a case against B, to file a case, and in case he does not file a case for 1 year, 6 months, 2 months or whatever, that does not discharge A from his liability. Okay, please take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask me. Come on. Please take 2 minutes, go through this carefully, and then we proceed. Come on, take another minute, please. Carefully go through this. Any questions, please ask. Come on, take another minute, please. Carefully go through this. Come on, take about 30 seconds, go through this. Any questions, please ask me. Carefully go through this. These are the cases where the surety is not discharged from his liability or the amount that he has guaranteed. Okay? We will continue with this. Take about 30 seconds. Go through this. Any questions? Please ask me. Come on. Any questions? Please ask. Okay, now this is the case where the liability of the surety is not discharged. Okay, now discharge of a surety by creditors act or omission by impairing surety's eventual remedy. Okay, so if the creditor does any act which is inconsistent with the rights of the surety or omits to do any act which his duty to the surety requires him to do, and the eventual remedy of the surety himself against the principal debtor is thereby impaired, the surety is discharged. It is the duty of the creditor not to do anything inconsistent with the rights of the surety. A surety is entitled after paying off the creditor to his indemnity from the principal debtor. If the creditor acts or omits, deprives the right of the surety for the benefit, the surety is discharged. It simply means, now like I told you earlier, if the principal creditor does any act which affects the subsequent remedy that is available with the surety, then the surety is said to be discharged. And like I told you earlier, once the surety pays the money on behalf of the principal debtor to the creditor, then the next right that the surety has is to recover that amount of money from the principal debtor. So if the creditor does anything which affects this right of the surety, then the surety is said to be discharged from his liabilities. Example, B contracts to build a ship for C for a given sum to be paid in installments as the work reaches certain stages. A becomes surety to C for B's due performance of the contract. C, without the knowledge of A, prepays to B the last two installments. A is discharged from the prepayment. Why? Because in case B had defaulted, then A would have made the payment to C and then recovered the money from C. But here, contrary to the agreement between A, B and C, A has prepaid the amount to B of the last two installments, so that discharges A from his prepayment. Okay. Example 2. A puts M, an apprentice, to B and gives the guarantee to B for M's fidelity, means his honesty. B promises on his part that he will at least once a month see that M make up the cash. B omits to see this done as promised and M embezzles. Embezzles means steals the money. A is not liable to B on his guarantee. Okay, why? A puts M as an apprentice to B and gives the guarantee to B for M's fidelity. B promises on his part that he will at least see once a month. Okay, so because B's job to at least check once a month whether the cash is proper, so B did not do his duty, and because of which M embezzled the cash. Okay, so in this case also A is not liable to B on his guarantee because B also did not fulfill his part of the guarantee. Okay, please take a minute, go through this. Any question, please ask me. Please take a couple of minutes, go through this carefully. Any questions, please ask me. Any questions, please ask. Come on. Any questions, please ask me. Please take another couple of minutes, carefully go through this. This is an important topic. Come on. Any questions any of you have, please ask me. Come on. Let me know once you're done, please. Are we done? Okay, then by the invalidation of the contract of guarantee. Now, guarantee obtained by misrepresentation is invalid. So, like we discussed earlier, if there is any guarantee or contract of guarantee that was created by misrepresentation or fraud, then that particular the surety is discharged from his liability. Any guarantee which has been obtained by means of misrepresentation made by the creditor or with his knowledge and assent concerning a material part of the transaction is invalid. So, like we said earlier, if the creditor gets the person to give a guarantee due to misrepresentation or fraud, then that particular contract is invalid and the liability of the surety is discharged. A guarantee obtained by concealment also is invalid because that becomes a guarantee obtained by fraud. Okay. So, any guarantee which the creditor has obtained by means of keeping silence as to material circumstances is invalid. There again, because there is a valid concealment of facts by the creditor. Let's look at the examples. A engages B as a clerk to collect money for him. B fails to account for some of his receipts and A in consequence calls upon him to furnish his security. So here B has already got a track record of cheating. So after that, A asks him that please bring me a surety. Okay, C gives his guarantee for B duly accounting. So B goes to C and says, give my guarantee, and this thing, so C innocently gives his guarantee. A does not tell C about B's previous misconduct. B afterwards makes a default again. So again, here it is held that the contract is invalid. Now, why is it invalid? Invalid because A did not tell C of the previous misconduct of B, and he basically concealed facts so that he can enter as a guarantee. Then let's take the second example. A guarantees to C payment for iron to be supplied by him to B for the amount of rupees 2 lakhs. B and C privately agreed that B should pay 5 rupees per ton beyond the market price, such excess to be applied in liquidation of an old debt. The agreement is concealed from A, hence A is not liable as a surety. Here again, there is an active concealment of facts by the principal, debtor and creditor with the surety, and because of which A is not liable as a surety for C's debts. Okay, please take 2 minutes, go through this. Any question, please ask me. Any questions, please ask. Come on. Come on. Let me know once you're done. Any questions, please ask me. take a couple of minutes more. Come on. Please take another minute. Okay, please take another minute. Come on. Are we done? Okay, so let's take a small break. We've taken about 90 minutes of continuous classes. Let's take a break for about 5 to 7 minutes. Okay, so we will resume at 1:40. 5 to 7 minutes, so go freshen up, stretch a little, go for a little walk, grab something to eat or drink, and come back in 5 to 7 minutes. All right? Yeah. Come on. Okay, go freshen up and come back. Okay, we are taking a small break for about 2 or 3 minutes, and then we will resume the session. Okay, we've taken classes continuously for 90 minutes. So we are in the middle of a small break for 3 to 4 minutes. Come on, I'm already here. All of you come back in about 3 minutes, 3 or 4 minutes. Come back from the break, and then we will resume this session. Come on. Come on, 2 more minutes. Everyone come back. Come on, 2 more minutes. Come back, everyone. We will resume the session. Come on, 1 more minute. Come back from your break, everyone. Let's resume. Come on, come on, come on. Come on. Is everyone back from the break? Okay, let's resume. Right? Chaliye. Now, let's look at the rights of a surety. Now, what are the rights of a surety? The surety enjoys the following rights against the creditor. Right against the creditor, right against the principal debtor, and right against co-surety. So his rights, the rights of a surety is broken up into rights against the creditor, rights against the principal debtor, as well as rights against the co-sureties. So let's have a look at the rights against the principal debtor. The rights of subrogation, where a guaranteed debt has become due or default of the principal debtor to perform the guaranteed duty has taken place, the surety upon payment of the performance of all that he is liable for is invested with the rights which the creditor had against the principal debtor. So this is a right of subrogation where you are put into another shoes of someone else. So it means A had guaranteed to B the debts, the loan he gave to C of 5 lakhs. Okay, so on due date, C defaulted. So what happened? B took the money of B took 5 lakhs from A. Okay, now what happens immediately? Now what A has done is duty. A stood as guarantee for C to B. So when C defaulted, A paid 5 lakhs to B, but that immediately puts A into the shoes of B. That means now B can file a suit for rupees 5 lakhs against C. Okay, so that is what you mean by subrogation. Subrogation simply means you're put into the shoes of someone else. So where a guaranteed debt has become due, or default of the principal debtor to perform the guaranteed duty has taken place, that means C has defaulted in paying 5 lakhs to B. Upon payment or performance of all that he is liable, so that means that A paid that 5 lakh to B because he was the guarantor for C. Once he has discharged his liability, then he shall be invested with all the rights which the creditor had against the principal debtor, which means A can now recover that 5 lakhs from C, and for that purpose he can file a case on C. Okay, that is the first right of a surety, that is the right of subrogation. Right of subrogation simply means you are put into the shoes of the principal creditor. Second, implied promise to indemnify surety. In every contract of guarantee, there is an implied promise by the principal debtor to indemnify the surety. The surety is entitled to recover from the principal debtor whatever sum he has rightfully paid under the guarantee, but not sums which he paid wrongfully. So under a contract of guarantee, there is a implied promise by the principal debtor to indemnify the surety. So there is an implied means it is understood. Even though it is not mentioned, it may not be mentioned in the contract, but it is understood that in the event the principal debtor defaults and the surety makes a payment on his behalf, then it is the duty of the principal debtor to indemnify the surety. And for this purpose, the surety can file a case against the principal debtor. Alright, please take a minute, go through this. Any questions? Please ask me. Any questions? Please ask. Let me know once you're done, please. Please take a minute, go through this, and then we proceed. Any questions? Please ask. Any questions? Are we done? Okay, please take about 30 seconds more, carefully go through this, then we proceed. Okay, then let's take an example. Example 1. B is indebted to C. That means B has to pay some money to C. And A is a surety for the debt. So A stood as guarantor for B. C demands payment from A and on his refusal sues him for the amount. A defends the suit, having reasonable grounds for doing so, but is compelled to pay the amount of the debt with costs. Now A has paid the money. Now he stood as guarantor for B. Okay, and when C asked B for the money, B refused. C filed a case on B, and A defends the suit, having reasonable grounds for doing so, but is compelled to pay the cost of the debt. So basically, A paid the money that B owed to C, and he cleared his debts. Now, however, A can recover from B the amount paid by him for costs as well as the principal debt. So now A stands into the shoes of C, and he can recover the principal debt and the other money from B. Example 2. C lends B a sum of money, and A, at the request of B, accepts a bill of exchange drawn by B upon A to secure the amount. C, the holder of the bill, demands payment of it from A, and on A's refusal to pay, sues him upon the bill. A, not having reasonable grounds for doing so, defends the suit and has to pay the amount of the bill and cost. He can recover from B the amount of the bill, but not the sum paid for the cost, and there is no legal ground for defending the action. Okay, so here everywhere we see wherever the surety discharges his liability on behalf of the principal debtor. Once he does that, then he can recover the money from the principal debtor. Let's look at example 3. A guarantees to C to the extent of rupees 2 lakh payment for the rice to be supplied by C to B. C supplies to B rice to a less amount than 2 lakh rupees but obtains from A payment of the sum of 2 lakhs in respect of the rice supplied. A cannot recover from B more than the price of the rice actually supplied. Alright, so now these are examples in which the liability of the once the surety discharges his liability, he can take that money back from the principal debtor. Okay, please take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask. Come on. Any questions, please ask me. Please take another minute, go through this. Come on, let me know once you're done, please. Any questions, please ask me. Come on. Any questions, please ask. Are we done? Okay, take about a minute more. Take about a minute more, please. Are we done? Okay, let's look at the rights against a creditor. Now, the surety's right to benefit of the creditor's securities. A surety is entitled to the benefit of every security where the creditor has against the principal debtor at the time when the contract of suretyship is entered into, whether the surety knows of the existence of such security or not, and if the creditor loses or without the consent of the surety parts with such security, the surety is discharged to the extent of the value of security. So, let's take a case where A gives a loan to B of rupees 10 lakhs, and in return for that loan of 10 lakhs, he takes a security. He takes his land papers. Okay, and now it doesn't matter whether, along with that, he takes a surety. Now, it does not matter whether the surety knows about this transaction or not, whether the security has been taken or not. Okay, so, but in case whatever security the creditor has, that same security will be available to the surety also in case the surety pays the amount on behalf of the principal debtor. And if without the consent of the, or without the knowledge of the surety, if the principal creditor moves or discharges that security, then the surety is discharged to the extent of the value of the security. So whatever is the value of the security, that much the liability comes down from the surety. Okay. Example: C advances to B his tenant rupees 2 lakhs rupees on the guarantee of A. C has also a further security of 2 lakh rupees by mortgage of B's furniture. C cancels the mortgage. B becomes insolvent and C sues A on his guarantee. A is discharged from the liability to the amount of the furniture. Why? Because C, if you see in this case, B has taken a guarantee from A for 2 lakhs and he's also taken a mortgage from B's furniture for 2 lakhs. So he has a security. So what has C done? C has cancelled the mortgage. He should not have done that without talking to the surety, because the surety is entitled to the same security that the creditor is entitled to. So the minute he cancels the mortgage, A is discharged from the liability to the amount of the value of furniture, which is 2 lakhs. So A is discharged from his liability. Let's take another example. Example 2. A creditor whose advance to B is secured by a decree receives also a guarantee for that advance from A. C afterwards takes B's goods into execution under a decree and then, without the knowledge of A, withdraws the execution. A is discharged. Now, basically what happened in the second case, C also had two securities. One is a guarantee as well as one is a decree. So without the knowledge of the surety, he withdraws the execution of the decree. So in that case, A is discharged from his liability, because the surety has a right to the same securities that the creditor had benefit to. Okay, please take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask. Come on. Please take a couple of minutes. Any questions you have, please ask me. Any questions, please ask me. Come on. Please take another couple of minutes. Any questions, please ask me. Come on. Take another minute. This is an important topic from the exam point of view. Take another minute, please. Go through this. Okay, any questions? Okay, now the next right that a surety has is a right to set off. if the creditor sues the surety for payment of principal debtor's liability, the surety may have the benefit of the set-off, if any, that principal debtor had against the creditor. So in case the principal creditor is supposed to receive some money from the principal debtor, and the principal debtor is supposed to receive some money from the principal creditor. So whenever the surety is discharging the liability of the principal debtor, he shall have a right to set off. That means whatever the amount that the principal debtor owes to the principal creditor, from that he can reduce the amount that the principal creditor owes to the principal debtor, and the remaining money he can discharge as liability. So the right to share reduction. The surety has the right to claim proportionate reduction in the liability if the principal debtor becomes insolvent. So in case the principal debtor becomes insolvent, then the surety also has the right to get a proportionate reduction in the amount that he is liable to pay to the creditor. Then what are the rights against co-sureties? Co-sureties, when the same debt or duty is guaranteed by two or more persons, such persons are known as co-sureties. So let's look at the rights of a surety against the co-sureties. Okay, co-sureties are liable to contribute equally. Equality of burden is the basis of co-suretyship. This is contained in section 146, which states that when two or more persons are co-sureties for the same debt or duty, either jointly or severally, and whether under the same or different contract, and whether or not, whether with or without the knowledge of each other, the co-sureties in the absence of any contract, to the contrary, are liable as between themselves to pay each an equal share of the whole debt, or that of the part of it which remains unpaid by the principal debtor. So it simply means, unless there is an agreement to the contrary, if there are more than one surety to the same debt, they are liable to pay equally to the liability. Okay, but if there is something agreed upon between them, a particular share, 80-20, 75-25 or whatever, then they will have to do it as per that. But if nothing is agreed, they are liable equally. Okay, please take 2 minutes, go through this. Any question, please ask me. Any questions, please ask. Come on, please take a couple of minutes, go through this. Any questions, please ask me. Come on, let me know once you're done. Carefully go through this. Come on. Any questions, please ask me. Carefully go through this, please. Come on. Are we done? Okay, take about a minute more. Come on, carefully go through this. Are we done? Okay, let's move on to the examples. Example 1. A, B and C are sureties to D for a sum of rupees 3 lakhs rupees lent to E. Okay, E makes a default in the payment. Now A, B, C are liable as between themselves to pay rupees 1 lakh each. So unless there is an agreement to the contrary, the co-sureties are equally liable to pay to the amount to the principal creditors. Let's take another example too. A, B, C are sureties to D for a sum of rupees 1 lakh rupees lent to E. And there is a contract between A, B and C that A is to be responsible to the extent of 1/4, that is 25%, B to the extent of 25% and C to the extent of 1/2. So E makes a default in payment, and as between the sureties, A is liable to pay 25,000 rupees, B is liable to pay 25,000 rupees, and C is liable to pay 50,000 rupees. Now, why do you think this happened? This happened because there was an agreement between the co-sureties as to what will be their liabilities in case the principal debtor defaults. So 25, 25 and 50% was what they agreed upon, and when the default happened, then in that case they are supposed to pay 25,000, 25,000 and 50,000 respectively. Then, liability of co-sureties bound in different sums. The principle of equal contribution is, however, subject to the maximum limit fixed by the surety owner's liability. Co-sureties who are bound in different sums are liable to pay equally as far as the limits of the respective obligations permit. What this means, let's have a look at an example. A, B, C are sureties for D, enter into 3 several bonds, each in different penalty. Namely, A in the penalty of 1 lakh rupees, B in that of 2 lakh rupees, C in that of 4 lakh rupees, and condition for D is duly accounting to E. D makes a default to the extent of 3 lakh rupees. A, B, C are liable to pay rupees 1 lakh each. Okay, so whenever there is a bond or whenever they separately give in writing that this is the amount of their liability cannot go more than that. Okay, so it also has to be in proportion to the amount defaulted by the principal debtor. Please take 2 minutes, go through this. Any questions? Please ask me. Any questions? Please ask. Come on. Please take a couple of minutes, go through this, and then we proceed. Any questions you may have, please ask me. Come on, take another minute, please. Any questions, please ask me. Come on, anyone, carefully go through these. These are important rights of the surety, and this is an important question from the exam point of view as well. Come on. Go through this, please. Any questions you have, please ask me. Carefully go through this. Any questions, please ask me. Are we done? Okay, let's take the last two examples. Example 2. A, B, C are sureties for D. Enter into 3 several bonds, each in different penalty, namely A in the penalty of 1 lakh rupees, B in the 2 lakh rupees, and C in 4 lakh rupees, conditioned for D's duly accounting to E. D makes a default to the extent of 4 lakh rupees. A is liable to pay 1 lakh rupees, B and C are liable to pay 1,50,000 rupees. Now here you see A is liable to pay 1 lakh rupees only because A has entered into a bond for 1 lakh. Okay, so out of 4 lakhs, 1 lakh is gone, and the remaining 3 lakhs, B and C will have to share it equally. So out of his 2 lakhs, he'll have to share 1.5 lakhs, and C out of 4 lakhs will have to share 1.5 lakhs. But A's liability is only to the extent of 1 lakh because that is what he has committed to pay. Okay, let's look at example 3. A, B, C are sureties for D. Enter into 3 several bonds, each in different penalty, namely A in the penalty of 1 lakh rupees, B in that of 2 lakh, and C in 4 lakh rupees. Conditioned for D is duly accounting to E. D makes default to the extent of 7 lakhs. Okay, so A, B, and C have to pay the full amount on this bond. So that means if the default is of 7 lakhs, A will pay 1 lakh, that is what he's committed. B will pay 2 lakhs, that is what he's committed, and C will pay 4 lakhs, that is what he's committed. So 1 plus 2 plus 4 is 7 lakhs. So they will have to clear the liability of the principal debtor in this particular proportion. Alright, so that's what it means. These are the rights of co-sureties. Please take a minute, go through this. Any questions, please ask me. Any questions, please ask me. Please take a minute more. Are we done? No? Okay, take a minute more. Take about a minute more. Any questions, please ask me. Okay, take about 10 more seconds and then we proceed. Are we done? Alright, so with this we end the chapter on contract of indemnity and guarantee contained in the Indian Contracts Act 1872. Once again, I would like to welcome you to crack CA exams with us, which is a vertical and channel of Unacademy that caters to the students of CA Foundation and Intermediate in their journey and pursuit of preparation for the CA Foundation and Intermediate examinations by providing top educators, quality content, and overall a great learning experience. So come, let's crack CA exams with Unacademy, India's largest online learning platform. Also, I would like to repeat that I strongly recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examination. So these are the 4 reasons among many others that I strongly recommend and encourage you to come onto the Plus platform of Unacademy as soon as possible. The first being the Plus platform of Unacademy provides daily live classes where you get to chat with your educator, engage in discussions, ask your doubt and answer polls, all this while the class is going on. The second reason is the Plus platform of Unacademy conducts live tests and quizzes on a regular and periodic basis, which help to evaluate your preparation and also get a detailed analysis of your performance. The third reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the structured courses it provides, where all the courses are structured in line with your exam syllabus to help you best prepare for it. And lastly and most importantly, the reason why I recommend and encourage you to become part of the Plus platform of Unacademy is because of the unlimited access it provides, where the one subscription to the Plus platform gets you access to all the live and recorded courses to watch from the comfort of any of your devices. So keeping all these advantages in mind among many others, I strongly recommend and encourage you to become part of the Plus platform of Unacademy as soon as possible. And also I request all of you to please download, install and register the Unacademy Learning app on your phones through the Play Store on your phone so that you can get access to all the live and recorded special classes that Unacademy has to offer to you, and you can get access to all the live and recorded Plus courses that Unacademy has to offer to you to help you to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. Okay, so I request you to download, install and register on the Unacademy Learning app as soon as possible so that you can make use of the world of resources that Unacademy has to offer to you. And here are the subscription packages for the Plus platform of Unacademy. The packages are for 1 month, 3 months, 6 months, 12 months, 24 months. The listed price of the packages are 3,500 for 1 month, 8,750 for 3 months, 14,000 for 6 months, 17,500 for 12 months and 21,000 for 24 months. Now please remember, these are the listed price. But before you make the payment for the package of your choice, please do not forget to use the code Prathik to get an instant discount of 10%. I repeat, please do not forget to use the code Prathik, Prathik, that's me, to get an instant discount of 10%. So the after discount price of the various packages are: the 1 month package will cost you 3,150, 3 months will cost you 7,875, 6 months will cost you 12,600, 12 months will cost you 15,750, and the 24 months package will cost you rupees 18,900. So you see, immediately you're getting a savings or discount of 10% when you use my code Pratik. Now there is an important announcement. This discount is being reduced to 5% from 1st March 2021. So in case you have thought about or decided to join the Plus platform of Unacademy but have not done so yet, this is the time for you to do it. Please do it now to get a discount of 10% on the above listed price, because from 1st March 2021 onwards it is becoming 5%. And while doing so, please do not forget to use my code Pratik to get an instant discount of 10%. I recommend you to start off with the 12 months and 24 months packages because it is very cost effective. Alright, here are also the links to view of the many special classes that I have conducted on the Unacademy Learning app. You can either click on these links or copy and paste these links on your browser to take you directly to the special class on the Unacademy Learning app. There are special classes on Indian Contracts Act, Sale of Goods Act, Indian Partnership Act, the Limited Liability Partnership Act, the Companies Act, Basics of Communication, Accounting Concepts, Revision Test Papers, and many more. So please log into the Unacademy Learning app, go to my profile Prathik Gupta, and start making use of the hundreds of hours of special classes that I've taken there exclusively for your benefit. Alright, so with this we come to an end of this session today. Thank you so much for being a wonderful audience. I hope you found the session useful. Please do not forget to use the code Prathik to get an instant discount of 10% when you use this code for the Plus platform. Please remember this discount of 10% is being reduced to 5% from 1st March 2021. So before that, please do get onto the Plus platform of Unacademy and make use of the 10% discount, as well as the various other world of resources that Unacademy has to offer to you to help you prepare for the CA Foundation and Intermediate examinations. And also, come, let's crack CA exams with Unacademy, India's largest online learning platform. Thank you so much, ladies and gentlemen, for being part of this session. I shall be coming up with more interesting topics and sessions in the time to come. Thank you so much for your patient listening. I really hope you found this session useful.